Hello, I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights to help boost your trading potential. Coming up, U.S. markets edging higher. Investors looking to shake off Monday's risk-off slide, maybe hunt for some catalyst to reignite a year-end rally. Plus, gold prices slipping following a recent 6-week high. We're going to dig deeper in today's technical take. We want to see if this is just some profit-taking in the precious metal or if there's room for further gains. And our trading debaters are standing by. They're going to break down whether Ulta Beauty's glow is fading or if it's ready for a fresh-faced rally. That's all ahead. Don't forget to like and subscribe. Always like us. You're watching TD Active Trader Live. You're half an hour into the trading day. Yesterday, the start of a new month, and it wasn't a great session on BNN Wall Street. It's nothing too dramatic. Wall Street's trying to shake it off today. You got the S&P 500 up just modestly at the open. Let's jump into the heat map. I'm being told by the wire services that it is a tech story, so let's see if that bears out indeed. NVIDIA, Microsoft, Broadcom, Oracle, Palantir, Apple, Google. You can clearly see Amazon, Meta, all in the green, putting some points on the table. Want to get into MongoDB. A nice pop for them out of the gate, handing in their latest quarterly report. They beat on the bottom line. They grew the top line as well. Revenue up 19% year over year. That really blew past expectations for the street. And they're raising their revenue forecast. They're in the database business, and so it seems that we got a little faith in tech today, at least in MongoDB. Bank of Nova Scotia, let's look at the New York listed shares. Canada's big banks, this is earnings season for them this week. They're all coming out in the next 3 days, starting with Scotia today. Beating estimates, better than expected results in the capital markets and wealth management divisions. Now, they did have to book a restructuring charge to cut expenses. Of course, we always watch loan loss provisions as well to get a sense of how they're feeling about the economy. So lots more to come this week from the banks. And that's your market update. Joining us now for more technical take on what is happening out there in the markets. Here in Amin, Jason Nadek from our direct investing educational team. Gentlemen, we also have special guests joining us today from our client engagement team. Everyone wave at the camera, say hi to home. That's your big moment here. We'll try to throw the camera back in a little later in the show. There'll be a Q&A, so get sharp, all right? Let's talk about what you're keeping your eye on. We were taking a look at the S&P 500. I think people are trying to figure out, we're going to get the Santa Claus rally.
Yeah, Greg, good job. First off, I'll say from last week, you got to the right person off the gate.
Oh, yeah, well, yes, you guys confused. Last week, everyone got confused.
There for you.
You see, you were away. You were in the States for US Thanksgiving. You still watch the program.
Exactly. I had to, big fan of it. So let's start with S&P 500, though. We saw just coming into yesterday, U.S. markets cooled off a little bit, coming off the rallies as of last week. Bit of a relief rally, but what you have, the picture that's been causing pressure is higher yields ticking up. You got weak factory data that came through, and then crypto turbulence is also spilling over, which is bringing about fresh uncertainty. But it's also that time of the year, as you mentioned. Are we going to have a Santa Claus rally? It's also the time of the year where you have a lot of these asset firms coming out and putting the projections out for the S&P 500. Goldman Sachs said they've already come out for 2026 prediction. They think the S&P can get up to 7,600, so that's about 11% upside from where it's currently sitting at. But some of the things that are going to be key for this week that can move the markets is going to be some of the data that's going to be coming out. We've got some of the private jobs report, the ADP numbers we still don't have the BLS yet, but there's also PCE is going to come back. It's delayed, but we're going to see PCE data on Friday, and I'll talk a bit more about it later in the show there. So coming into it, what we're also seeing with S&P, you did a good job covering it last week, was the breadth. We're seeing weak breadth. There's very narrow leadership, and you also have policy risk that's really going to create that uncertainty for us. And crypto is one to keep an eye out, which means there's going to be a pressure that's going to spill over into the equity space. Looking at the charts here, what we have so far in the year is we have this big rising wedge pattern that I put on since the April lows over here. Now, with this rising wedge pattern that you can see, typically is an indication of a bearish reversal to the downside. We did see that break of the pattern happen. We did see it test the 65.50 low not too long ago, and then broke back up, which was a previous support, which used to be a resistance at 67.60, but now is acting as a support level now. Now, what we do have clearly the resistance that it needs to still breach is that 68.85 level, which kind of marks the previous highs over the last couple of weeks. So that's the next level we need to tag to get past it. However, When we look at some of the candlestick formations that we look at, they do tell us there's possibly some downside risk because of an evening star formation, and tends to happen at the top when we see a little bit of momentum weakening there. So this is one to see for the end of the week how this plays out.
I feel like you picked up an American accent. Did you hear the however?
I did hear that.
However.
Oh, did I?
Yeah.
However. All right, interesting. We'll put that
Well,
on
we'll
the
put
side.
that one aside.
Gold. What are you seeing
All right,
there?
gold. All that glitters is not gold, apparently, but in this case, it is. So that's what we're going to look at. So gold's also had some of the similar sort of sentiment because you've seen a bit of risk-off sentiment come in, and that's buoyed up gold. But again, it goes back to what's happening on the yield side of it, especially across the world. Globally, yields have been pushing higher. Gold's going to be pressured by a couple of things. One is the Bank of Japan, BOJ. They're going to be having their announcement this week, and that could, there's probably expectations they're going to bump up, hike up their interest rates as well. And then you've also had the split FOMC coming next week to making that announcement as well. It's coming right around the corner, right? So this is going to possibly put a little bit of turbulence into gold's sort of sales that it's been sailing through so far. And also China's demand has weakened as well, significantly for gold as well. So what that means is if we look at the charts, we see this long consolidation phase in the summer. We went on this long bull trend. We touched new highs, just sitting at that 43.98 previously. This is the futures contract, I might add, not the spot price. And what it has formed since then is this telltale double bottom pattern. What do we say about those W's? Those are wins.
Those are winners, yeah.
And we're going to see a big bullish move up here. And we see this, it's rejected off of this line here. Once it has the break, which it did today, it's now testing that, which is this resistance is now becoming support. Is as long as we get for the next consecutive days closes at it, that 42.20 level. Gold sitting at 42.54 right now. It could potentially move to that 44 level on its way up over the next couple of weeks sitting here. So this is what we'll be keeping out, but very much still in bullish, positive territory.
S&P 500 and gold, you're looking at a home builder.
We're looking at a home builder. So we're looking at Toll Brothers. They've got earnings coming out next week and wanted to highlight them. Just a little bit about them. So they're more of a kind of the high-end home builder right there. They're looking more customizable, more premium features, kind of the more looking after those luxury or affluent buyers, but kind of stepping back and thinking about some of the macro trends we're seeing. I know we're still waiting on current data with the government shutdown, still kind of working through kind of some of that data, but late into the summer, which is typically can be like a higher demand period, was actually saw a big drop in kind of month over month in home starts, down 7%. The biggest impacts were in the south, down a whole 21% in terms of the previous month, and then the Midwest was kind of second worst in terms of geographical areas, almost 11%. But forecasting out into next year, even took a look at the TD economics reports, still looking for increasing of 7.5% into 2026 for the U.S. market. But thinking here about Toll Brothers, what makes them luxury? Their average home price it's tipping up towards $1 million per home in the U.S. Talking USD here, $967,000 versus kind of looking nationwide around $512,000. So that's that can cut both ways when we're talking about those prices. Maybe their customers might not be as kind of in tune with any economic slowdowns and more able to kind of cover those cost increases. But what that does pull away from is Toll Brothers' maybe ability to kind of be well positioned for the fast-growing entry-level market. So kind of really be interested to hear about that when earnings comes up. But let's jump into the charts just real quickly here. So we can see that there were some lows kind of earlier in spring. We see this kind of cup and handle forming. But one of the things we like to talk about is that a pattern is not actually going to be confirmed until the price action confirms itself. So we have the cup and handle proceeding through the end of the summer where we see the handle, but what we don't get is that break above the top here. What's really kind of interesting as we kind of get into the earnings period is that we failed to breach above the kind of the opening of the cup, and then we actually gapped down, and the stock is now twice resisted, kind of going above that. So we're kind of in towards the top end of the range and with the prices weakening as we head into next week's earnings. So we're really looking to see what we see there, and then that broader housing data when that comes out, that's going to be a big big telltale sign what's going to be successful or lack thereof of this company going forward.
Yeah, any indication we get right now, I was trying to catch up to all the data that was sort of kept from us during the lockdown. I love how in the States it's true. In so many markets, $1 million is an entry to luxury. If someone's watching us from Toronto, it's like $1 million. You watch those American real estate shows, like young couples, like just getting started in their careers. They need a 9-bedroom house with a swimming pool, and a 5-car garage, but we only have 200,000. It's like, we think we can do something for you. And you're always like, what universe are we living in?
Yeah.
There's areas in the States where that's still a reality, right?
They're not living in the GTA, that's for sure. All right, thanks for that, guys.
You need to go to Michigan to go.
Get those prices, right?
There you go. If you have a home question for us, or just a question from home, here's how you reach the team. You can get in touch with us at td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try out the platform risk-free. You open a practice account by clicking on the Try TD Active Trader button. Then when you're ready to switch to a live account, simply export that workspace and start trading for real. It is time for the main event, trading, debating. The stock in the spotlight this week is Ulta Beauty, an American beauty retailer known for its mix of cosmetics, skincare, and salon services. These two gentlemen, of course, always availing themselves of salon services.
Yes.
Me too. Before we get into the debate, just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only and should not be considered investment advice or buy, sell, or hold recommendations. Options trading carries high risk and may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Now back to the stock of the hour, Ulta Beauty. What made you two manly men pick Ulta Beauty to debate?
Well, I was just in the States not too long ago, Greg, for Thanksgiving, and Black Friday happened to be around
Your skin does look good.
Yeah, it does. I might have tried a few
nice glow to
samples,
it,
and
right?
there's a glow to it that comes up, and so I figured, let's see what the rage is about. We don't have it in Canada, but we have Sephora, which is a sort of an equivalent brand. But it's also, there's a time-tested theory called the lipstick index theory. Heard about that one? So the theory basically says during economic hard times, people still go out and spend on small indulgences, and they liken to one of them being lipstick, or premium lipstick in this case. So I want to see if, with the consumers hurting a little bit, whether that theory still holds true just based on the foot traffic that was in Ulta. So I may have gone in purely for research purposes.
Research purposes, and the skin's looking better on the other side. What about you, Jay?
Well, this is the largest, retailer in the beauty space in the U.S., so really interested to see kind of how this plays out. But they've also got really aggressive expansion targets. So, and they've also, as you mentioned, they've got lots to offer, and then salons in all of their locations. So, is this going to be the best of both worlds for both a consumer and an investor perspective? Time will tell.
All right, a little pampering. Let's give some time on the clock here. You get your 2.5 minutes each to make the bull and the bear case. As always, we draw from a hat. Jason, you got the bull.
I did get the bull.
You are bullish on beauty.
I'm bullish on beauty. How could I not be? That's right. So Ulta has become a beauty powerhouse. According to Euromonitor, its share of the specialized beauty retail market back in 2012 was just 12%. Now over in 2024, they're over 34%. So a huge increases, big time gains in those. Now they're industry leading in that particular space. They've become a one-stop shop. Now it's just not premium brands that these are offering. They're even offering like drugstore brands. So there's something there from everybody, and there's even an opportunity for you to maybe pamper yourself if you want to splurge a little bit, even if you're looking to save a little bit of money at the same time. And they carry a massive array of products. So there's, once again, it's going to be a one-stop shop, something there for everybody. But there's many things that the company has been focusing on that's really kind of turned it into, really have a solid financial footing and really an earnings kind of with extreme profitability. And I don't say that lightly. So, all right, so Ulta just recently posted quarterly revenue in Q2, almost 2.8 billion, which is almost a 10% increase year over year. So we're talking big multiples here. And then over the last 12 months, we've seen revenue has jumped significantly as well, almost a little over 11.5 billion. The company is maintaining healthy margins. We're looking at profit margins of 10%, gross margins almost 40%. These are big multiples, whichever sector that you're talking about. And then ROE, return on equity, very high, in almost a little over 48.5%. So big times there, and they're generating strong returns on capital. But these metrics are setting Ulta up for growth into the future. Analysts have boosted outcomes. They're looking at their revenue outcomes going forward. And then one of the nice things here is that Ulta's actually got I mentioned it off the top, they've got a really aggressive expansion unit, and we'll touch on that later in terms of the stores they're looking to open. But one of the things that is leading me, they're generating this successfully, is there's almost no debt on their books. We're only talking like $237,000. That's less than those home prices that I was talking about is what Ulta's got on their books at the time. But let's jump ourselves into the charts so we can take a look and explain why we think this could go higher. We're looking for repeatable events here. Their last four earnings events have shown that there's been significant prices on the day of and leading into the weeks after. We're thinking over 20% on average. So if we can get that to play out, we've still got considerable room to grow. And if we look at continuing on those trends, looking at more recent terms, big gap up in Q1. Out of that Q1 gap up, we saw those prices were tested. Double bottom, confirming the trend is continuing. That pattern's been repeating itself, leading into earnings that are happening, just next week. Hoping for those trends to continue on the right way.
Bullish on beauty, bearish on beauty.
I'm bearish on
beauty.
Yeah.
What's the case to be against beauty?
Well, the case I'm not
Put them in a
against
tough
beauty.
spot, yeah.
Ulta Beauty. Ulta
I'm
Beauty.
very much a proponent of beauty, but I'm not a proponent of Ulta's beauty story. I think their growth story is running on fumes, to be honest. And the bull side, as Jason eloquently put it, is basically they're applying a thick layer of high-end foundation to this stock. And they're trying to cover up really the deep blemishes underneath, and we're going to peel back with the stock today. So the bear side is all about bringing the micellar water, and I learned all these terms because I went in there. I don't know what they do or what they're for, but I understand they take off the foundation, and that's what I'm about to do here. So let's start with the competitive pressures that we're going to talk about first. The battleground's shifting. Once it used to be Ulta's playground, but now you've got competitive forces from all angles that are attacking Ulta's growth story. So you've got discount retailers, you've got e-commerce, which is the biggest one in the name of Amazon. You've got just normal retailers, department stores, you name it. Everyone's in the beauty space at the moment there. Also, one of the biggest things is, Jace mentioned that they've captured certain market share from 2012 to 2024. 2024 actually marked the first time in the company's history that they lost market share. And remember, this company has one single exposure, and I'll paint the picture here. Sephora is probably its biggest competitor in the premium beauty sector space. Sephora has 3,000 locations in 35 countries. Ulta has half the locations, 1,500, in one country.
Just the U.S.?
They have geographically exposure to the U.S. with competition on there. So I'll mention that as well. The other thing to also talk about is they've had the growth expansion story. They've had a self-inflicted wound. Sephora's been able to partner with Kohl's. They've put in about 1,000 stores right now and projected to hit that by the end of this year. They're well on track to it. That's giving them exposure to the U.S. market. That's competing directly on Ulta's footsteps. Whereas Ulta had partnered with Target, but now they're closing out that partnership because they weren't able to hit that goal and the fruition never happened. Let's go into the charts and tell more about the story here. So here's what I've got the daily chart pulled up on Ulta Beauty. And we can see, the stock was on a significant, uptrend since April, as many of the stocks were through that period up until now. But what we do have is we see a little bit of rejection happening at the tops now that we did form. Now, what this has indeed formed is one thing I wanted to mention was a bearish reversal pattern. That's a head and shoulders that's forming. It's still forming. I will say it hasn't completed. We still want to see it trickle down and head towards that 480 level. But I am bearish at these levels where we see a rejection, where we're seeing a bearish candle today coming back into that space. Also, the other thing I will mention is that we do see these clouds that are negative momentum clouds there in the Ichimoku clouds.
Just keep digging it.
You say about jammed. They got jammed. They got jammed. I was going to
Yeah.
get aggressive, and I was like, what's going on? What's going on? Okay. Nice cases. You got 3 minutes now to jump all over each other.
All right, let's do that. So we're talking competition. One thing that's got the competition drooling is Ulta's loyalty program. This is something that is industry leading. Ulta has a retention rate. We're talking of 95% of coming from those customers that are loyalty. They've got over 45 million customers in their loyalty program. So that's driving revenue. It's causing clients to spend more per visit because of tailored promotions within their loyalty program. As well, they're making customers return more frequently. And this is the one thing that I like here in terms of revenue growth is that it's predictable, right? They've got proven data from the past that their customers are based on this program are continuing to show back in their stores. So I think this is a big win for
Jay,
them.
I'll tell you this. So loyalty programs are great, but they're only as strong as the incentives that they offer. So yes, while you paint a good number, 44 million members is a fantastic number, but that's not a moat. That's a mailing list. And I'll tell you why it's a mailing list, because in this environment, loyalty is not a brand. It's what's the best deal. And when you have competitors like Sephora and Amazon at your doorstep. Those $44 million members, I should say, are highly targetable customers for the competition. Loyalty cards easily transferable, but margin is not when we come to some of the numbers. And let's actually talk about some of the margins, because you did mention, you threw some numbers in there, and I wanted to go back to Sephora's story. So Sephora, we know, is owned under Louis Vuitton Hennessy. But just for comparison's sake, the revenue-wise, I think Ulta does about $11.5 billion projected annually. Sephora's at $15 billion. When you look at comparable same-store sales growth, Ulta's sitting at between that 2.5% to 3.5%. Sephora does 3 to 4%. But here's the big kicker: when you look at gross margins, 39% on Ulta, but Sephora is at 62% gross margins. So that just tells you how much space that they have on there. And then when we talk about the big pressure that I think is cost pressures that you haven't really discussed with Ulta. But where's my numbers over here? They have actually came out in the last quarterly earnings. They have said that they're expecting to increase 280 basis points on their SG&A expenses. So, this means your gross margins are being impacted because they're going into
what they are increasing.
What
they are increasing is share buybacks. So they're believing in the story and the product that they're selling, and they're returning equity back to their shareholders. What we've talked about here is they've got a $3 billion authorization.
It's a competition,
right?
And you're going to invest.
And where
why
Ulta
would you invest in the best?
And where Ulta is competing here is they're continuing to expand in their store models as well. We talked about being U.S. only. Well, they've actually just completed an acquisition. Let me make sure I get the name right. Space NK. So they're now got plans to open up stores in the UK, and they've got partnerships forming to open up stores in Mexico as well. So this is a blossoming story, a blossoming flower, if you will.
It's too nascent, though. It's too early stages to even call numbers on that.
That got spicy, didn't it? They were really getting at each other. But you were like testing my faith in humanity. He's a bear against beauty. People only care about money, but well argued, both sides, gentlemen. It's time to jump into the platform and look at possible ways to play it through option strategies. Why don't you take it away, Jay?
Yeah, I believe oftentimes in the KISS method. That's just me with my charts, and it's also me with my trades. Sometimes let's keep it simple, stupid, right here. So what's an easy way to be bullish and kind of minimize your upfront costs in terms of just buying out the shares itself? Well, that can be done with buying a long call. So you're controlling shares with less upfront capital, so that's less risk to you, but still get to play in that kind of the upside unlimited profit potential if you do get large moves in the direction that you're predicting. So let's jump ourselves into the chart. So Hiran was mentioning forming head and shoulders. Well, in this particular case, we've got an uptrend, forming into ourselves into a bit of a continuation triangle that I've got on the screen. And if we can get, if the stock does break out and confirm out of this downward sloping, triangle that's coming out of an uptrend, then that can signal the trend will continue. Meaning that if we get an opportunity to then ride that up, that's where a potential bull investor could see profitable trades. So let's go ahead and bring up the trade that we could make here. So the trade that's potential here would be buying an at-the-money call that's around 550 here today. We're going a little bit out past earnings. So earnings are coming up with this week, but these are the options expiring out through next week. So it gives us a bit of time to still continue to ride that bullish wave if it does happen. Right now, costing us around $23 a contract. So that's putting the break even $23 above our strike price. So that's up to $573. But if we look at the expected move that the market's got priced in out through the end of this week, it's just a shade under $50. So if we get it all to the upside, that's an opportunity for us to continue to make profit above and beyond that. Thinking about profit, just like if you own a stock outright, your max upside potential is unlimited. The higher the stock goes, the more money we're making in this particular regard.
Your max loss, of course, what you paid for the contract.
Yeah, that's exactly right. Got that on the chart for you. I know you'd like to see that. So $23 a share, $2,300 a contract. That's much less than the exposure. So that's that leverage that options are giving you. I'm not needing to spend out $50,000, $55,000 for 100 shares. We're only talking about $2,300 in this case.
Yeah, interesting possible play. How about you, Hiran?
Yeah, so bringing up the charts again, Greg, one of the ways that you could play it if you have a bearish inclination is doing a bear put spread trade. So this is a directional trade. So we're speculating that the stock could come down coming to this earnings play. There's a couple of reasons why we went with this trade. One is, given that this stock trades at 500 and change in this level, the options are usually going to be very expensive around earnings. So by doing a spread, what we're doing is we're capping how much it costs, the overall cost outlay, by selling another option, put option further down. So the one I've mapped out is based on the levels identified. So we do see potentially a key reversal, looking to buy the 535 put contract going out to the January cycle. And going further down, looking at the next potential level where we might see support in that price, which is the 495. So this gives us a 40-point wide spread that we're doing. This trade is going to cost us $13 on a single contract, so that means $1,300. Where our break-even stands is you just take the cost of the trade, which is 13 minus the long side of this contract, which equals $522. So we want the stock to get down to at least $522. But the more it falls from there, we start making a profit at that point. The max profit in this case is going to be the spread, which is $40 minus what we paid, $13. In this case, the difference is $27, so $2,700 on a single contract. And I've just got this risk profile mapped up here, which gives you a sense of that visual. You can see as you go below the 535 level, we start going into that profit zone over here. But our break even really stands at 522, which is when we start making an actual profit here. And then it does get capped. Remember, we do get capped on the downside at the lower short strike. So this is at 495. So if the stock continues to drop even below that, we won't make any more profit, but we have reached our max gain, in this case, $2,700.
All right, interesting possible strategies there on the whole beauty thing, not Ulta Beauty, but more than 20 years ago, early in my career in journalism, I did a little stint in the lifestyles department. So I'm interviewing this guy. There's a real push at the time, more than 20 years ago, to get men to buy beauty products, right, and skincare stuff. And there really hadn't been a big push there. And so I do the interview, and in the end, I say to the guys, between like us two men, right, do men really need all this much? And you know what he said to me? He goes, by the time and the age I am right now, if you want your face to look like an old wrinkled leather bag, go ahead, my friend, don't moisturize. He scared me straight. I moisturize every eye because I was like, well, I'm not going to take a chance, am I? Got to moisturize.
Yeah,
and I think you guys do too. You're looking pretty youthful as well. Thanks for laying at the bull and bear cases for Ulta Beauty. Just a reminder to our viewers that this debate was for educational purposes and does not reflect our personal opinions about the stock. Now, before we move on, Jason, you're going to actually show us how to find fundamentals information on the
Yeah, this is part of the research that Hiran and I both do, and it's in the platform. This is kind of short and sweet, but kind of unless you understand where the hidden gems are, you might not know where to go in the platform. So let's kind of jump ourselves back into that. So there's more than just fundamentals here on the platform. So I'm going to bring us to the Analyze tab here at the top of the screen. And I'm on the sub-tab, aptly named Company Fundamentals. What's going on here is we've got some research reports, right? We've got some external providers have been putting in. There's some Argus reports, Morningstar. The Morningstar Analyst Report is one that I read on a regular basis when getting prepped for the show, so maybe give that one a check. Got information here about the company. We got links to their investor relations page. But if we're thinking about fundamentals specifically, that's going to be towards the bottom of the screen. You've got a lot of the key metrics that we looked at. We talked earnings per share. We talked PE. There's some other valuation metrics that are down here, so really lots to dig into. The one thing that I really like to, once again, I'm a keep it simple, stupid guy here. We've got these little charts that helps me just to kind of give a peg here. It's just one column in the sheet here, but it gives me that trend. We're not just looking for pricing trends, but here's trending within the fundamental information. This is a 5-quarter trend, and if you actually in the top right-hand corner toggle that from quarterly to annually, get a bit of a bigger longer-term picture in terms of kind of how those metrics are faring against each other.
All right, all important parts of the discipline. If you at home have a question about the TD Active Trader platform, or if there's a stock you want to see these two guys go head-to-head on, send us an email, td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. Before we wrap up this lively show, some of the key things that our investors are focusing on. What is on the radar for the rest of this trading week here?
Yeah, we've closely looking at inflation and consumer sentiment this week, Greg. So first off, this week we've got the ADP report coming out, so that should give us offer us more and fresher insight into the labor market and how the government shutdown. Their data doesn't come out till December 16, in fact, so that's going to be after the FOMC decision. And this is usually seen as a harbinger of the BLS non-farm payrolls report, in fact. What's expected right now is not much. The ADP report does make about 1/5 of the private payrolls in the U.S. They're expected to come in about 42,500 for November, which is roughly in line with what October's number is. But you also have a wave of layoffs that hit global companies this year. And if you remember October, the Challenger report, they noted that they were cutting more than 150,000 jobs in October. This is the biggest reduction in the month in the last 20 years in the US that's happened. So the challenge report's also going to come on the back of that. But then all eyes are going to turn over to Friday. You got the PCE numbers finally coming out. Economist expectations for September. We're still talking about September. We're into December now. To come in at 2.8%, which is a slight uptick from August 2.7%. But the good news, which is the core, which strips out, the volatility of energy and food, that's supposed to come down to about 2.8 from 2.9%. And that's going to be a key tool going to that FOMC decision as one of the sticking points to see whether we get that rate cut.
That is their preferred gauge of inflation, right?
Exactly.
They look at.
And they're priced in at 85% of as what the CME FedWatch tool is saying for another rate cut happening in December. But apart from that, we're also turning my attention to a stock by the name of Synopsys, SNPS is the ticker symbol. So they're making a bit of a wave in news headlines as of yesterday because they came out and Nvidia just announced a partnership with them.
It was a $2 billion?
$2 billion.
Get you
It sounds like a small change, yeah. It gets some attention,
friends,
It feels like a small change with the numbers that are being thrown out these days. But Synopsys is a chip design software maker, so they offer services for silicon design and electronic design automation to help these customers build AI-powered products. They also have their earnings coming out next week on December 10th. EPS expectation is $2.79. It does mark an 18% decline year over year, but on the top line, they're expecting to grow that about 37% year over year to $2.25 billion there. Now, they do have a little bit of negative press coming in. They're dealing with a significant lawsuit from their last Q3 report about alleged securities fraud that had happened, especially with one of the design IP segments and reporting those numbers. So that's something that might weigh in. We might hear for comments on that, but also we may hear for more comments on this multi-billion-dollar partnership with Nvidia and how they expect what the roadmap is going to be with that design. But looking at the charts here on the stock, let's see how it's fared so far. We can see it's been on a long downtrend channel going back into July of 2024. We did see this break that had happened, but then this was the Q3 report I mentioned, Greg. We hit a massive 36% gap down, and this is also the time that lawsuit had come out as well. So it hasn't quite recovered. Gaps tend to get filled, but this is what we call a bearish breakaway gap. We've touched it just below the 21-day moving average, but you can see this yellow line, which is the 21-day moving average. And I'm going to just zoom in a little bit. This is acting as a dynamic support area right now. It has broken through based on the Nvidia news, just broke over the 50-day since going back before the Q3, which was last time at that level. But what I'm more concerned about, this downtrend, we haven't had confirmation yet, which means that it's not, we need to see at least 2 to 3 closes above that line to say, okay, we've now started potentially a short-term uptrend here. So this is what's going to look out. We've got a catalyst of the earnings coming out next week, which might push it there or put it back into the downtrend.
Definitely an interesting one to watch. Good economy, bad economy, people got to eat. You got a grocer.
You're right. People got to look for groceries. And we're looking at Kroger here today. They've got earnings coming out Thursday, the 4th, after the bell. When you strip out Walmart and Costco and look exclusively at grocers, Kroger is actually the largest when we're thinking about by store count in the U.S. In addition to the 2,900 stores, they've got 1,700 fuel centers, 2,300 pharmacies, and they've actually got 32 manufacturing facilities making in-house products. So they've got a pretty wide assortment of grocery-related items here. So think about them from an earnings perspective. Consensus is $1.04 per share, which is up modestly from 98 cents the previous year. And they're actually one of the things that with many retail, we're looking same-store growth, right? It's forecast to be just a shade under 3%, 2.9. So that'll be something here. But this is a no-moat type of business, right? I know Hiran's already expressed his disfavor of loyalty programs, but Kroger's leaning on the loyalty programs.
Really just all about the money, Hiran.
It is. That's all it is in this economy.
100%. So we're thinking about, and that's one of the things. These loyalty programs are trying to get to see how with key employment data, inflation, tariffs. These are challenges. Even when people need to spend, it's where they're going to spend their money, and are you going to be looking for lower cost alternatives? It's a tough competition when we're thinking about the grocery business. It's online fulfillers are there, and then we can't discount the Walmarts and the Costco in this world. They're competing for the same dollars that Kroger is. But jumping ourselves into the chart, we've got a kind of a forming triangle pattern that we've got on here, but this can be looked at initially as a bullish pattern, but these also can be in reversal patterns. They're thinking about the trend coming into the pattern as we come out. We've rejected off the top of the downward slope, so we continue to see lower highs on we go. But if we do jump out of the bottom, if we don't get, like what the market's looking to hear, support doesn't land on this particular stock until we get down to around the $61 level. So we're in a bit of we're in a bit of an area where the stock is certainly not decided where it's going to go, but we do have some very wide ranges that the company might project to. $70 on the top side, it would be the resistance that's demonstrated going sideways. Once again, the 61 level on the downside is where Kroger might fall to if the numbers and the analysts aren't hearing what they're putting down. They're not liking what they're putting down.
All right, some food for thought there for our audience as we head into some of those key events. That is the show for this week. I want to thank our guests for joining us. Give yourselves a round of applause. Ooh. And these two guys too. They always do such hard work. I just got to ring the bell and drink it all in. As always, investors at home should perform their own due diligence before engaging in trading. We're not going to have a show this Thursday, but we will be back next Tuesday at 10 a.m. for another trading debate. Thanks for watching.